The bull bear battle reversal, also called the triple B reversal. And if you can trade this effectively, you will not be going to the Better Business Bureau. The money will be in your account. Um, but this is probably the one of the toughest ones to trade. It really takes a lot of stones to trade this one, and you got to be patient. Of course, like you don't have to be patient trading otherwise. um, but we have a trend. So we have this trend, and what will happen is when we see like significant and aggressive trends, the steeper the trend, then again the weaker the trend is, and as price rallies and liquidity thins, and you have an increasing price with declining volume, you often get like an aggressive fall. But here, when we have a significant trend, what will happen is we'll often see a real battle between the bulls and the bears because a lot of the latecomers want to jump into the trend while those who have been accumulating positions throughout the trend start to square off or start to move out of some of their trends or start to scale down positions or scale down on some of their position sizes. And as we certainly do with our managed funds. um, and what we'll see here is we start to see some late converters coming in who are convinced that the trend is going to continue because you have sentiment. All right, let's at the base of any trend, you have speculation, and you have the buildup of speculation when nobody else is really looking, and it's not until the the bidding or the buying interest starts to come into the market, and as the trend begins to pick up, then it draws more attention to that trend. As more attention is drawn to the trend, you get more people converting um, into this currency or into this instrument, or the various instruments that constitute the flows um, to establish this trend, and then that just gives more force to the trend, and it continues, and people are building positions, and different hedge funds and so forth are building positions. Then by this point they're in a nice they're sitting on a nice profit, and they start to scale down in their position sizes. Meanwhile, as sentiment becomes very profound in a trend, then it's not until then that a lot of the latecomers become convinced that this trend is effectively in place, and they now want to participate in it. Therefore, they enter into the market while those who have been in the market for a while start to square off their positions. And we see a lot of this in the commitment of traders data as well. You'll see it if you've got your hand on the pulse of the market and the whole economic spectrum. You'll see that as attention is drawn to this trend, it's an opportunity for the larger funds to liquidate their positions. Then you see these latecomers coming in, and you get a real battle. And in the charts, we see very, very sloppy price action. And while some people may have made money here, they often give it away in this choppy price action because they it's so easy to make here. They bring in the same mindset that easy money will continue, but it doesn't. The market environment has now changed, and so we get in this choppy battle, and often we see like a rounded top, or we see simply like a declining top, where we see very, very discrete market lower highs and lower lows, and then finally price will break down. And then as price breaks down, those who began to accumulate positions on this side, on the latter end of the trend, start to immediately bail on their positions, and they throw their positions into the market to get out, and it really creates a shift in the flows of that instrument, and we will often see an aggressive fall. What I just explained is somewhat explained here, and we will go over it in the next couple of samples. This is a 4-hour chart, Australian dollar, and we see a real aggressive trend from 7,600 down to just below 7,300, so a 300 pip run. You see how the market moves so quickly here, and then we started to slow down, and the market labors to make lower lows and lower highs. Then we start to make higher highs, discretely higher highs, and discretely higher lows. The consolidations within this range can be very tough to trade, although they're very distinguished. You see how they're separated here, and they're separated here, where the market trades in its ranges that we've been talking about for the last 10, 12, 16 hours on these CDs. Price comes down for a last retest, but it's very, very choppy. It forms like a V formation or kind of a rounded formation low, but a real uncertainty in the market, and then we start to see real liquidation of positions here, and the price, the trend reverse, and naturally there's a real spectrum of stimulus and sentiment change that comes into the market during this whole formation, and that's important to note. That although we are looking at the technical factors, you really need to know what's going on a fundamental level as well. The nice thing about this 4-hour chart is it permits us in all this choppy price action, because on a 1-hour chart this would look real ugly. But as we step back and view it on a 4-hour chart, look what we have here. We have support, resistance, becomes a significant resistance level here. Support becomes support, and look at the big move that happens here. And again, it's a case of increasing price on thinning liquidity. Then when buying dries up, we have a significant drop, primarily because of lack of buying interest, and then partially because of selling and squaring of positions. And then price settles in at about 62% retracement, and then continues the trend up. Because this whole move from here to here starts to shake out and starts to stabilize the accumulated positions in this area here. On a technical level, if we look at this first initial key reversal downswing, price falls to 162%, and then moves right down to 262% of the initial key reversal downswing. When you see a key reversal downswing extend to 262% extension, you can often see potential, like a nice retracement from that point. As well, here the market moves into a state of MACD divergence. Euro, key reversal downswing, and then look at this choppy price action. This can be real tough to trade, but the market is making discretely higher highs and higher lows, and then one last spike down before the reversal. Let's go back to the previous slide. One last spike down before the key reversal. V formation or rounded formation, one last spike down before the key reversal. Another discrete point here is look at the strong up moves, and then price tries working its way down, boom, and it gives in. It tries working its way down, boom, it gives in, making higher highs and higher lows, tries working its way down, economic report here, spike down, and then boom, a reversal. And finally the bears give in, and we see a key up leg in the reversal formation. On another note, you see this important high over here extended weeks down the road. Hello, hello, key rejection, big move. You got to watch these levels, folks. Not rocket science. It's not a fancy gizmo algorithm, neural network. It's just price reference points overrides. Big up move. The market has to digest the move, and what it does is these key up moves are usually the pricing in of the expectation of some economic data that will be coming out in the near future. And then what it will do is it'll consolidate. And what the market is saying at this point of consolidation is it's saying this is about this is our assessment or our valuation of the currency cross in question. And they're saying this is what it's worth right now. This is what we think it's fairly valued at based on the information that we have coming out of both of the regions. And as well, then we consolidate. They consolidate even more narrowly, waiting on the an important economic report, which disappointed. Actually, it was a U.S. economic report, and it actually exceeded expectations, so I'm sorry. The market was pricing in a negative number. The number was positive for the U.S. I'm sorry. I thought I was looking at a Eurozone chart. I'm looking at a Swiss franc chart. So it disappointed. It disappointed the market, and we saw a significant repricing of the currency cross as a result of the number that came out in that day. Excuse me for that error. Price comes down, and where does it come down to? You see this consolidation range here? Provides support to the market. I just drew these lines in here to show you the key levels of support and resistance that the market establishes and acknowledges and trades within these parameters. And then look at this. You see this high here? Price does a triple top rejection, a nice tweezer top here, before a generous fall of excess of 300 pips. By the way, I'm not going to edit out my mistake. I'm going to leave it in there. And I do very little editing, as you may be able to tell by the phone ringing and so forth. But I'm leaving it in there just so you know that I make mistakes occasionally, simply by misinterpreting this as a euro cross, but it being a Swiss franc cross. Swiss franc 4-hour, and coming off a nice uptrend, we see this choppy price action. But look at the choppy price action. Look at how it makes discrete lower highs and lower lows. Usually these highs are they're often 79% retracements on the previous swing or on the swing from the high. And we make price labors to move higher, quickly rejected. Labors to move higher, quickly rejected. Laboring to move higher, quickly rejected. One last spike high and rejected. This is actually a head and shoulders here. And then quickly rejected. Labors to move higher, quickly rejected. You see the patterns? And then finally giving way. As these levels of support here start to give way, then we see some real aggressive moves. It's kind of like it's like when you have buying interest. You have interest to bid at certain levels with the anticipation that the uptrend is going to continue, but they just keep getting weaker and weaker and weaker into the selling pressure, and then finally they give away. And you see here how price has deep retracements, and then the retracements become shallower and shallower and shallower on the way down. Very important to notice this in the price swings. Here, this is a 60-minute chart, again a Swiss franc, and this is just a short-term one where we see a nice move. Pretty consistent, well-patterned downtrend as defined by these levels of support and resistance. Then we get into this choppy price action. What a lot of traders will do is this will be very, very kind of easy to trade or nice to trade. And then when price comes down here and sticks in a moves into a level of consolidation or period of consolidation, then traders view this probability as the same. But we're now entered into a new market environment. And when we enter into a new market environment, probability shifts to the low side, and traders start to get the profits that they've accumulated in the downtrend start to get eaten up. And some of y'all may have been there, but they get eaten up, and you just give everything back, and you don't want to do that. You want to recognize that you're in a period of consolidation. You want to trade it accordingly. I mean, look, if you trade the rejection of these lows, boom, there's profit to be made in here. Trade the rejection of the highs here or the resistance, and then here consolidation narrows, tough to trade in here. Break the trend line, and then we start to reverse. The reversal really, this is our first hint at reversal, this consolidation above these highs, and then further confirmation of reversal, consolidation above these highs, shakes out a few there, and then moves. If you traded the breakout of these highs, consolidation up here, and had a stop down here, this can really bug you. But there is plenty of room to put your stop below the lows or below the 38 or 62% retracement on this upswing. But these shakeouts, if your stop is too tight, it can really kind of tick you off, because it'll shake you out and look at the move once it decides it's not going lower. And here we have this was the second leg, and it was strong, and then price continuation. Look at how it patterns though. Look at the resistance becomes support. Tell me that that's not the most profound. I've been pounding home for, I don't know how many hours these CDs are, but I've been pounding home this resistance and support. It is probably the most predominant pattern that we've seen in every chart that we've seen, which should permit you to conclude that this is a critically important component of trading. And I hate to keep driving this home, but again, it takes us back to the internals of the dealing desks at the major institutions, and the volumes of calls and demands to flow funds through their institution, and their reference points that they use to determine and facilitate their trades in order for them to be profitable on the dealing of their institutional funds and various instruments. Absolutely important, folks.